This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
And we're glad to have you starting your day off with us here on the Retirement Solution with financial advisor Jon Hicks, founder of J. Hagan Capital, and here on the radio to share with you some of his insight as far as planning better for your financial future. That's, of course, Jon's goal and the goal of his entire team at J. Hagan Capital, working to empower you with information so that you can have the life you want to live. Now that you're finally wrapping up on the 9 to 5, let's put it all into plan for you for the years ahead. 502-317-0840 is the number to dial and begin the conversation with Jon and his team at J. Hagan Capital. You can also do that on our website, retirementsolutionradio.com, or it's 502-317-0840. So it's the weekend. Maybe you're getting outside, running some errands. I do love. Okay, first of all, do you have a step tracker of any kind, Jon?
A ton of them. My ring does it. My watch does it. My phone does it. Okay. My wife does it. She tells me all the time if I'm, how many more steps I need to take on that honey-do list. No, everything tells me that I need to be hustling more is usually what it boils down to.
Some people have talked about how it can be toxic because you get so obsessed with it and it actually can have negative impacts on your health. I do love the running errands steps. How many steps you can get in on a Saturday running around town is amazing. You look down and you've got 12,000 in by 1 o'clock in the afternoon. I'm
telling you, toting stuff around to soccer games, I have found you get an unbelievable amount of steps. As a matter of fact, there have been very few soccer games that I've gone on to the weekends with the girls where we have not gotten and exceeded, 10, 11, 12,000 steps, even though I didn't do anything, quote unquote, active
you didn't even
that
know
whole
you did
day.
It,
other than just go out to the grandstands or the bleachers or whatever. But there's so much walking between where you have to park and where the fields are and the next field for the next kid to get back to da-da-da-da-da-da.
And on it goes.
It is impressive, though, that technology can do this for us.
Right. Sometimes I get suspicious. Sometimes I'll look down and it's like you've had 3,000 steps today. And I'm like, fake news. I've definitely gotten more than that. Here's the good news.
It feels like more than that.
It does.
It feels anyway. That way.
The good news is, if you have struggled to get your 10,000 steps in a day to stay healthy, there's a new study, and I actually have heard about this. They say, if you try to get over 5,000, 7,000 is what this new study is showing, that as little as 7,000 steps a day can promote nearly the same health benefits. Now, when it comes to calculating our savings for retirement, just like our steps, we can get obsessed with this one big number. And it actually can work not necessarily in our favor, Jon. So we've done conversations on this radio program about how we'll get obsessed with that one big number at the bottom of the statement. Or there was even a TV commercial touting about what's your number to get you to retirement. This magic number, there's been different studies that have shown the current magic number. They say $1.8 million is how much you're going to need to retire.
Sure.
Others say, no, just have 70 to 80% of your annual salary.
Sure.
All we want to know, Mr. Hicks,
yeah.
how do we figure this out? What do we need to factor in to figure out what we will need to retire?
This is a big one. I love this. And I'm going to unpack this question because I really am interested in both sides of it.
Okay.
Number one, let's talk about that study that came out. So 10,000 steps has been this thing. And I can't remember whether it's Fitbit or whoever it was, the very first group to do it. But they said 10,000 steps. Now, Heather, do you know where that actually came from?
I do not.
10,000 steps actually came from a 1960s Japanese marketing campaign.
Ooh.
Not a joke. It did not come from science. That is where it came from initially. A 1960s Japanese marketing campaign, not science, is what suggested 10,000 steps, which is amazingly ironic.
Yeah.
Amazingly ironic when you compare that to the financial services world, which come up with something like the number or the la. It's meant to sell a product.
Interesting.
And so at the end of the day, I think it's amazing. So what this new study came up with, what I thought was amazing, because there are many days when I'm out with the kids and I'll get 12, 15, 18,000 steps when we're traveling. Yeah. And we like to be, I'm going to call it adventuresome travelers. Yeah. We don't just sit on the beach. We typically like to go explore, whether it's a big city or we go to Europe or whatever. We enjoy that. Yeah. And I will often eclipse 20, 25,000 steps on a big day when we're looking at stuff. But the amazing thing is 10,000 steps has been set as the standard. If you get as few as 7,000 steps, you will still potentially have a 47% lower risk of death, 25% lower cardiovascular disease risk, significant reductions in diabetes, dementia, depression. That, guys, is huge. So the point is that if you have a game plan and you stick to it, good things happen. Even if you don't get 10,000, maybe that's the goal, but hey, that's like shooting for the stars or shooting for the moon. If you just surround yourselves by a couple stars, that's not so bad, right?
Yeah.
So same thing. So here's where I'm going to compare this to financial planning.
Okay.
I hear all the time, John, I'm going to retire when I get 2.2 million, 1.2 million. As soon as I get to $1 million, whatever their number is, 750,000. Guys, that to me is so arbitrary. Now, I know we're wired this way. There's almost nothing we can do about it. But the issue is are you either hurting yourself by waiting too long where you could be enjoying downtime? You could be enjoying those vacations, getting those steps in like I do when you're going down a European city street or things like that. Are you hurting yourself? Or here's the other thing. Are we just prolonging the inevitable, right? Procrastination. Those are issues. So when I think about the numbers, the myths, people get freaked out. Northwestern Mutual did a study not that long ago that said that Americans are going to need 1.46 million nearly to have a comfortable retirement. Guys, I cannot tell you how many times that people will come in and like, John, I haven't saved enough money. I don't even know why I'm here. I just don't think I'm going to be able to retire. I have less than half of that saved. And ladies and gentlemen, no joke, you would be surprised how many of those people I get to smile at and say, you're good. Tell me how you want to live your retirement. Do you want to live your retirement like you've been living your life? Do you want to have lavish vacations and go on Viking Mediterranean cruises? You just want to go hang out with the grandkids at the lake every once in a while when it's time to do that? Do you want to eat out every single night at, Michelin restaurants? Or do you just like to go to Jaggers or Taco Bell or take your pick of your local, Mexican restaurant and just a couple nights a week, have some food? Because they have completely different outcomes, the numbers that we need. But I watch people get paralyzed by thinking, well, I'm not a millionaire, I can't do that. Guys, you can live a better life than you realize if you have the right plan, which has nothing, and I'm serious, almost nothing to do with investments. It has everything to do with having a properly designed plan that encompasses the big pieces. We're going to go through that.
Okay.
So just like that Japanese 1960 commercial, a marketing campaign ended up propagating a myth, I want to cut through all the myths. What you own is so much less important than how you own it and where you own it. What does that mean? You need to have protection. If you're in your 50s or older, especially if you're in your 60s or 70s, you need to know how much of your portfolio is protected against losses, not just market losses, right? But erosion because of inflation, because of interest rate erosion, any of these things. You need to know what is protected first and foremost, because if you lose more than half or 30% or 25%, you may not be able to stay retired. So protection's number one. Number two, how much income can that support? Whenever someone says, John, I think I need like $1.9 million to live, I always ask them, hey, just out of curiosity, did your current guy come up with that? Where did you come up with that?
Right.
It's like, well, just based on what I've read or based on what someone said. I'm like, guys, you only need a third of that to live the way you want. Why? Because your replacement ratio. So when we look at it, most every one of us are going to have a few guaranteed income buckets in retirement.
Yep.
Maybe we're lucky to have pensions, but most of us are going to have Social Security or some type of federal program. So because of that, we're going to at least have one guaranteed income stream. That's good. If you have an annuity or a pension, then guess what? You have two different guaranteed income streams. So then what do we have next? Well, then we have our savings. So how much do you want to pull from your savings? Well, first of all, we need to figure out how much do we need? If we have Social Security coming in, we have another guaranteed form in the form of a pension or other things. That's good. But if we don't have that, then we have our money from savings. Okay, well, how much more do we need, right? Because when we figure these things out and we figure out what do you want to do in retirement? Do you want to sit around and watch TV in your house? Well, no, I want to do something. Great. What does that something cost? Guys, when we start with expenditures instead of with dollars saved, it has a completely different outcome. And guess what? It's much more realistic. Because there was a study I read a couple months ago, and it talked about how the biggest travesty in America is people dying later in life and with a fortune left over.
Yep.
Why? Because they were too afraid to spend any of it because they just always felt like they'd run out. Guys, that is a psychological issue that you can overcome, but you have to see it actually written on paper in print so that you can recognize. One of the things that we do in our office is we never oversave for our needs. We always want to make sure, because I'd rather you spend it. I'm not even joking with you. I'm one of the very first financial advisors you will ever talk to that says this is your life's work. Enjoy it. I want you to front load your retirement. I want you to go take the grandkids on vacations if you're into that. I want you to go do fun things with your spouse. You didn't have the opportunity to do that. And I want you to do it before you're too old or infirmed or hurt or in pain to where you can't enjoy it. Yeah. In America, we have put our nose to the grindstone. We have put the pedal to the metal our entire lives. And I want us to take advantage of that. That does not mean spending money like a drunken sailor. It simply means, can I do the things I want when I'd like to do them, when I'm young enough and healthy enough to enjoy it? Guys, that is a good retirement. It's not some silly mythical number. We can do magic with what you have accomplished if we approach the game plan correctly. Protection, income, tax design, wealth transfer, and healthcare. Those are the 5. They will never change. We may have to add some to it over the years, depending on what the administration does or what markets do or what artificial intelligence does. But realistically, those 5 things can keep anyone able to sleep at night and enjoy their time. So when I see this thing and we finally realize, wow, 10,000 steps wasn't even rated in truth. 7,000 steps would decrease my cardiovascular risk and increase my life expectancy by that much. Yeah. So, well, if I'd known that, I would have stuck with it, or I would have done it, or I would have actually had a plan in the first place. Today, I'm inviting everyone. Come get a plan. Yeah. Get a good one, not one that's built for the advisor, one that's built for you. What do you want to accomplish? What are your real dreams? Not the ones that we'd like to tell ourselves when no one else is looking, the real ones. What do you want it to look like? If you don't have a skilled fiduciary who understands the tax and legal aspects, who understands it's not about investments, it's about how your money works for you, we invite you to get a second opinion. It's the one thing I can offer today that I think will make most people feel confident that whatever numbers you're seeing, you can probably do them with total comfort.
Let's plan a time for you to get this second opinion from Jon and his team. The number to dial right now is 502-317-0840. 502-317-0840 to put a time on the calendar for an initial 15-minute phone conversation with you and one of our advisors. This is a no-fee, no-obligation space, just an initial conversation for you to ask some questions, understand how at J. Hagan Capital we might be able to help you figure all of these things out, figure out what you really need for your retirement, not what some marketing campaign is telling you that you need, but what you really need. It begins with this initial 15-minute phone conversation, and we're ready to schedule that for you right now. Give us a call at 502-317-0840, 502-317-0840 to put a time on the calendar. You can also go to retirementsolutionradio.com, or it's 502-317-0840. After working and saving for many decades, being a responsible adult, raising your children, getting those little jokers out of the nest. Now it's time to focus on you and your spouse, your wifey, your hubby. Let's go have a good time, baby cakes. That's what I'm going to be saying to Kyle anyway in about 20 years.
Yeah. Mm-hmm. So baby cakes, that's your term of endearment?
Baby cakes.
Mine's sugar bunches.
Sugar bunches. Sweet.
Not to be confused with honey bunches of oats.
That's
I think
right.
that's trademarked. I don't know if that's a Maha approved cereal, but I don't think they used a bunch of imitation stuff in it, so it's probably still okay.
Got it. Well,
but yeah.
Let's save that for another radio show, okay? Let's not go down that rabbit hole today or this week. Please help me. Jon, obviously, here on the radio every week, working to share with you his insight on ways to better prepare for this next phase of your financial life. So as you're listening today, if you've got questions for Jon and his team, we are here to help you get some answers. The phone number is 502-317-0840. That's how you start the conversation with Jon and his team. 502-317-0840, or you can find us anytime at retirementsolutionradio.com. All right. Let's just start at the top and work our way down, shall we?
Let's do it.
So Q4, we're obviously in Q4. It's end of year. There's lots of things to think about. We always know that this time of year is a volatile market time of year. Here comes the Fed, as we anticipated, beginning to make those cuts, the interest rate cuts. They have already done that by a quarter of a point. They have signaled there may be more to come before the year's end. I think economists are expecting 2 more cuts before the year's end, whether those will be quarter points, half points. Asset manager Alan McKnight is telling CNBC that we're paying too much attention to the drama that the Fed is bringing, Jon. Here's what Alan McKnight said.
We had so much angst going into this where it was going to be this big major deal and all these things were going to happen, when in fact it was pretty quiet and pretty calm. And so as we look out over the future meetings this year, our hope is that we'll have similar type of situations where the market doesn't react in a visceral way. Let's get back to earnings. Let's get back to what are companies doing? What are they seeing at the tip of the spear, rather than expending so much energy on trying to prognosticate what the Fed is going to do.
Drama, John. People love drama, though.
That is the least dramatic thing I've heard this month.
Well, he's saying he's been saying we've been making up drama, that it really was calm. And
I know. And that's the whole point. Yeah. So when you don't dramatize something, it allows us to actually focus on what's important. And what I heard him say was, hey, things really weren't all that bad, no big deal. But he mentioned two things. And it's very interesting, whenever you have an administration like we have, they shed light on things very differently. Very different shades of light can be cast in any given second. Mm-hmm. The fact that the president has had all kinds of words to say about the Fed, specifically Chair Jerome Powell, and the fact that they did decrease rates, whether it was as much as people thought or not enough, really is kind of irrelevant. The point is that we as citizens who are just trying to hopefully save some money, get to the point where we can retire and then retire and do the things we want. Here's the craziest thing that I got out of this.
Okay.
It doesn't really mean that much, right? So there's essentially two sides of the spectrum, if you will, when you're thinking about what this rate cut means. Number one, if you have a lot of debt, then this may be very good for you, right? It could be very good that the Fed is starting to reduce rates so that you can maybe have less credit card interest rates. You can maybe have a lower mortgage rate. If you've purchased a house in the last couple of years, maybe it's going to start, although I don't think it's happened yet, start to create a situation to maybe refinance to reduce some of those costs. Mm-hmm. And that could be very good, right? So for those that have a lot of debt or trying to knock down debt, this could be a very positive thing. Now, you have the other side of that, Heather.
Okay.
The other side is where a lot of folks, as we're getting closer to retirement or in retirement, it's where we find ourselves. We have money that we want to earn interest on, right? Whether it's our bank CDs or our savings accounts or our money market rates or our bonds or our fixed annuities or whatever it is. We have those things. And now what we're realizing is, if the Fed may continue to cut rates may be as good now is they're going to be for quite some time, right? And a lot of people think that means that we need to focus and change something immediately. Well, in our office, we don't feel that way at all. As a matter of fact, this is probably one of hundreds of rate adjustments that we will see over the course of our retirement. Sure. Literally, guys, dozens, if not hundreds of rate changes, whether they're up or down. And the question is, if we're hanging on every word of a Fed chief or the Federal Open Market Committee, if we're hanging on those words, we probably don't have a really good game plan. So one of the things that I tell all my clients is if we do the right thing and set up the right type of plan, it won't matter what they say. It will make no difference whatsoever. It will potentially open new opportunities for a 2-month period or a 6-month period or take your pick. But most of the time, it shouldn't matter that much at all because it really comes down to, and again, what we focus on the show is about how do we get you from having to have a paycheck to having a retirement check, an amount of money that you can live off of weekly or monthly or annually, however you look at it. We want that income to be succinct, and we want it to come in consistent. We want it to come in no matter what. And most of our clients, this rate cut, frankly, it gave them a lot of opportunities, regardless of how they're creating income. And that's the big thing I think we want to focus on here.
Understanding that if the Fed drama has caught you off guard lately, or if it has you concerned, and the words John just spoke to you, it's probably due to lack of a plan, if that's giving you some awareness. Let's start the conversation with John and his team. 502-317 0840 is our number to set a time for a 15-minute initial phone call with one of our advisors. This is a no fee, no obligation first step in the planning process, just a space for you to ask some questions. We explain how we might be able to help. And again, help you work through this one of many different dozens of times, maybe hundreds of times that things are going to change in retirement. Hopefully you're going to be retired 20, 30, 40 years. Lots of things can come in that time. But at J. Hagan Capital, working to help you build a plan so that despite what goes on in the world around you, you're going to be retired comfortably and confidently. 502-317 0840 to plan a time for your no fee, no obligation 15-minute phone call with one of our advisors. You can also visit us at retirementsolutionradio.com. Obviously, the income strategy you were just pointing out, getting you from your working paycheck to your retirement paycheck, you call our play checks a lot, John. What Absolutely. Do we need to know in this space of where we are existing currently?
So when it comes down to those 3 to 5 years before you retire or when you're in retirement, it all focuses income is the ultimate outcome, right? Now, this is very different. This is a paradigm shift. When we're making money and putting money away, and we've got years and years and years before we retire, growth is usually the primary objective. We want to grow that big old pile of money so that we can live off it one day. But once we get between 3 to 5 years, we really want to have income to be the ultimate outcome, which means here's the real secret. Everyone that's going to consider retirement in the United States of America needs between 3 to 5 completely separate and different income streams in retirement. I'm going to say it again. At a minimum, you have to have 3 different income streams. So for instance, if you have Social Security, and then you also have savings that you can pull from, and then let's say you have a rental real estate, so you get Airbnb income, or you rent your lake house and you can rely on that, and then that's another form of income. What else would be part-time work, selling things on Etsy? Any number of things that produce income are great. If you have an annuity stream, if you have a pension, these are all really good things, but we need 3. And the most successful people I see, and if you look at multi-millionaires and billionaires, guys, these guys have dozens of different income streams. Shark Tank. Most people look at Shark Tank and they're thinking, oh, these guys are making hundreds of millions of dollars. They're looking for return on their investment. They're looking for income. Believe it or not, when you listen to what Mark Cuban actually says and Mr. Wonderful Kevin O'Leary, and you actually read what they're saying, they're like, hey, no, we got money that we make all the time and it's sitting idle. We want to make investments where we can potentially make 7, 8, 9, 10, 12. And then, of course, in their situation, how do they make 12 to 50% a year on that investment as income? They could really care less about the growth. They want income. Income is the ultimate outcome. So now that rates are starting to change, I want to focus on 3 specific things that every single one of us can think about. Because again, like my clients, we always are looking for opportunities. Whatever the Fed does doesn't really matter. Doesn't change our plan at all. We know we're going to win. The point is that what at the end of the day can we do differently? This may be a good time, especially if you had some high growth octane. You've had some NVIDIAs and some Microsofts and some S&P 500 and some NASDAQ things in your portfolio. This may be a good time to consider converting some of that or looking at dividend aristocrat. Historically, these are dividend growers. Now, what defines a dividend aristocrat? These are typically large companies that have increased their dividends 25 years or more consecutively. So these are guys that, hey, no matter if we have a good economy or a bad economy or a weird economy or a stagnant economy, these guys are increasing their dividends. Now, why do we say that? Because right now, a lot of these companies, and you can get good quality exchange traded funds, you can do an actual dividend aristocrat strategy, all these things, they're paying between 5 to 7% a year in straight up quality dividends to the investor. Now, why is that good? Well, because number one, it has a track record, 25 years plus of increasing dividends. Well, that's pretty good. And if the market seems kind of expensive, these guys, regardless of heck or high water, they seem to keep paying out. So that allows us to have an income stream even when things are weird, right? So a dividend aristocrat strategy can be very attractive for some people. Another one to consider now that rates may be dropping. And why am I saying this? Because all of a sudden those money markets and CD rates and bond rates, they're not going to look so attractive going forward, especially if we have more rate cuts on the way. So another thing to consider are covered call strategies. We're often seeing a lot of different covered call strategies where we're basically saying we're not betting against the economy. We want the economy to win. But even if it doesn't go up much, we still can get an income of between 6 to 8% on that money by getting money from call options, which is also very attractive. And the last one I'm going to mention today are income-based structured notes, where you can have a very attractive downside protection, sometimes 30 or 40 or even 50% downside protection. But as long as the market or those companies you invest in, as long as they don't go down more than 30 to 50%, it's going to pay you a stated rate of interest. And we're seeing those in the 6 to 9% range. So again, that does not mean that any of these, and many of them are considered securities, it doesn't mean that they're right for anyone or everyone, but these are things that as rates start to drop, these start to look very attractive when the market's very expensive and interest rates may not go up from here.
Jon and his team here to help you understand which of these strategies may or may not work for you, for your goals within your plan. Let's start that conversation. The number you're dialing right now, 502-317-0840, 502-317-0840. Give us a call. A teammate standing by off the air ready to answer and help you set a time for your initial 15-minute phone call with one of our advisors. 502-317-0840. If you're over 59, if you've saved $500,000 or more, this is where you're really going to feel the power of this kind of planning take effect. It begins with this initial no fee, no obligation 15-minute phone conversation to ask some questions, and then we'll explain to you how we might be able to help and offer you ideas on these different kinds of income strategy options. John, the things you were speaking about, honestly, I was sitting here Googling them as you mentioned them, strategies I had never heard before until you brought it up today. But this is the kind of thing you're pointing out to people at J. Hagan Capital every single day. Different options. Maybe you're working with an advisor before. Maybe you're a DIY investor and you've never heard of these kinds of things before. John and his team, they want to explain to you what they are, how they might work for you. So let's start that conversation. Give us a call right now, 502-317-0840. You can also go to retirementsolutionradio.com, or it's 502-317-0840. Of course, the work that you do, John, it's not just about the financial planning. At least here on the radio, week in, week out, it's about helping us understand all the mixed messages and information that we get, because this just in, everybody. Surprise, surprise, conflicting information. When it comes to our market risk, are we scaling back at the right time? Now, you may have heard that as you get closer to retirement, you want to look at de-risking, and a time frame that's often thrown around is 3 to 5 years from retirement. But here comes new information saying actually it's 10 to 15 years out from retirement, John. So I say to you, with all due respect, sir, what's up?
Yeah, no, it's interesting. So for years and years and years, we always heard 3 to 5 years before you get ready to retire.
Yep.
You just want to make sure that some major drawback, some major market blow, some major black swan event doesn't cause you to not be able to retire at the right time. So 3 to 5 years has historically been the standard. And lo and behold, all of a sudden, here comes a study. Was it Kiplinger that did this?
Kiplinger.com.
Kiplinger did a study.
Yep.
Yeah. So Kiplinger did a study and they say, okay, hold on, wait a minute. I know we've been talking about 3 to 5 years, but maybe we need to talk like 10 to 12 years out, right?
Yeah.
And it's kind of like all of a sudden, but it did make me pause, and I did read the article and I went through all the background information, and there is a case to be made. First of all, let's do this.
Yeah.
There is a case to be made for early risk reduction, especially if interest rates are as high as they've been. So I'm wondering if this piece is not going to be a little bit of period specific, because right now, at least the Fed just changed rates. But here recently, we've had really great interest rates if we wanted to lock in some safe money and maybe get 5, 6, 7, even 8% with relative safety. You can do that, of course, with money markets. You can get close. You could have gotten close to 5, 6, or 7% on structured notes or principal protected notes. I saw some annuities out there not long ago that were paying 7 or 8 or 9% for income distributions for people. Those are rates that we have not seen ever, at least in my nearly 25 years in the industry.
Tenure,
those were crazy rates. So you could make a case and say, hey, if you pull back risk early, look at all these great things you can invest in. Those aren't that far off from long-term market returns. Now, having said that, I think it's really dangerous, especially when we look at inflation rates and what they've been doing, right? So the last administration, we had hyperbolic inflation. Why do we have that? Well, because of COVID, right? And that wasn't the last administration's fault, but we had COVID issues, and those caused everyone to clamp down. It caused all kinds of production nightmares, supply issues, demand issues, and that caused this whole system on the cogs to get all messed up, right? And then all of a sudden we have free flow of money going into the system, and it causes prices to skyrocket out of control. You put that on top of a free money situation where the Fed had interest rates basically at zero for so long, and hookah, you have crazy inflation. That's what we've had. So that's why in 2022, the Fed increased all of these interest rates. They increased them up to the highest that they've ever gone. I think it was the second fastest ever in the history of the country that interest rates went up that far, that fast. And what did that cause? Well, it caused inflation to slow down, which has been positive, but the markets have done nothing but gone up since then, which is really interesting. Okay. So what I think this Kiplinger article was trying to suggest is, listen, we may be entering a portion of the economy where the markets may not perform as well as we would love for them to do. Why? Because they've come up so far so fast. But because interest rates are still pretty good, maybe you can take some risk off the table and do okay. And I'm just very nervous about that. And a few reasons for that. But the main reason is because of inflation. Because what we're seeing right now, the Fed is not reducing interest rates because inflation is truly tamed. They're reducing interest rates because we have a job issue in the United States. We basically have a jobs recession already. One of the studies that I recently read talked about Stanford graduates with a better than B average unable to find initial positions out of college. Guys, think about that. If Stanford grads are having a hard time getting a job, there may be a bigger issue, right? So the things we have to understand is if we are going to have a jobs recession and you couple that with the fact that artificial intelligence is keeping on and clipping on, and maybe we won't have some of these entry-level positions anymore, that makes me a little nervous. I think that we might need to not just descale risk. I think we need to reassess where our income streams are going to come from. Because Heather, I think it's one thing to say, oh, I think we need to de-risk. It's another thing is like, okay, if we go down to a lower risk environment, what are our expected returns? Right? I think one of the things that we really need to consider right now is like, what are income streams that we can pay into at an earlier phase? Should we look at lake homes that we can make Airbnb money off of, right? Or Verbo or that kind of thing? Should we look at investment properties as secondary income sources, or looking at rental properties? When you look at the younger group of Americans, they really don't want to own, at least right now from large studies, they don't want to own their own homes. They'd rather rent. So could there be money in those type of environments? Maybe, if you like the idea of real estate. And I'm a huge proponent of real estate. If you look at the majority of self-made millionaires in America, many of them were made that way because of real estate. So I think real estate is a great opportunity to consider. Now, is that really de-risking or scaling down risk? No. It's diversification of risk. It's making certain that amount that you're paying for that home, or even if you have a loan against it, right? I'm not against that. Leverage is how billionaires get to be billionaires instead of just millionaires. But if you look at that, I think that income stream could be great. So when we're looking at these things, de-risking, I'm a little curious about if that makes a lot of sense. 3 to 5 years is a pretty long period of time. But I think the real probably answer, Heather, really when you look at it, is gradual. How gradual do you want to, not just all of a sudden, hey, I'm going to retire in 3 years, now let's de-risk. The question is, at what phase should we really start looking at pulling some of those gains off the table and start looking in, maybe I should diversify for income reasons, not just for risk reasons?
If you have questions about a time frame on when to begin de-risking your portfolio as you get closer to retirement, Jon and his team, they're here to help you figure that out. You can give us a call, 502-317-0840, or visit us, retirementsolutionradio.com. Call us right now, 502-317-0840, to schedule a time for your initial 15-minute phone conversation with one of our advisors to begin this conversation. All right, let's talk about time frames, because one of the things that we mention a lot, particularly on your radio program, is we always say, if you're within 5 to 10 years of retirement, give us a call.
Yes.
Thinking about risk and timeframes overall of our retirement plans, what do you recommend as far as timeframes go? Because I imagine, do you see it a lot where people will come to you, they're a year from retirement or they've just retired, and it's like, wow, I really wish you had been here 3 or 5 or 10 years ago. We could really have done a lot more work.
Literally every single week, someone comes in and says, man, where were you 10 years ago? I was here.
I was right here.
Just didn't have a big enough megaphone. Yeah, I was here. I just didn't have enough big enough megaphone, or you weren't on the frequency we were talking about. My frequency seemed a little bit more stodgy, a little bit more holistic, and not really about growth, right? Because one of the things, Heather, that we fight with every day in our office is human psychology, right? The stock market has been on a tear. NVIDIA is through the roof. Apple is making more profits than they have in a long period of time. Microsoft looks good. Google is got over this class action suit that they had with other things. Everything appears, at least the stuff that we hear about all the time, cryptocurrency, everything looks so good. And if we've had some money in that, we've made fortunes. And many of us are like, that psychology kicks in. It's like, man, but you know what? I've been getting while the getting's good. Why do I want to back out of here and either de-risk? That sounds horrible. Put my money in a money market. I make nothing. But my whole thing is like, maybe you don't de-risk. Maybe you just take some of that. Let's be honest, guys. There's a lot of luck. I know there's a lot of NVIDIA geniuses out there. I own quite a bit of NVIDIA because it's come up so much, but I'm not going to lie to you. I bought 20 other stocks at the same time. None of them did as well as NVIDIA. So I'm going to be very honest and say there's a good bit of luck that happens there.
And also, is everybody that's bragging about NVIDIA being as honest as you are, Jon, about it's like all this money I made off of NVIDIA. Okay, what else did you buy in the meantime that you've lost on? A lot of people wouldn't be honest like
because
that.
I fight with my own psychology every day. I'm just like, should I pare a little bit of that back? Should I just take a 5% reduction in that? Maybe, knock off and only the capital gains rate and then put it in something else. Should I maybe look at another condo to rent out or something like that? I think about this stuff all the time and I fight it internally myself. So the real thing is that what I've discovered is that most times that we're having those internal demons and angels fighting, it's really just a lack of a game plan.
Okay.
So in my own portfolio, I do not manage my own investment portfolio. I've done this for 25 years. I have 3 master's degrees, mostly in finance and mathematics. And I do not manage my own money because my emotions ruin me. They've done it nearly every single time. From investing stuff for my kids to anything, I am not great at it because my psychology gets in the way of the truth, which is, hey, you just destroyed that. You get 400% returns. Let's take at least 25 to 30% off the table. Now, here's the point. I don't think you have to de-risk it completely.
Okay.
Just diversify it. And what did I do? I bought real estate. And what did I do with that real estate? I made an income stream out of it. And in a few years, that real estate will be paid for. Hopefully, it's still producing a positive income for me that my family can utilize whenever we want to. And we're not able to use it, we can have that income from it. There's great gurus out there that talk about real estate investing all the time. I listen to them. They're really smart, but it's because they had a proper game plan. In our firm, what we want to do is we do not want to encourage only market investments. We want to encourage any investments that done correctly get you to the game plan in the end, which is hopefully to not have to work for someone else to be able to retire. That's really the whole point. And it's 5 things we have to do. We have to protect what we got. We got to create an income stream for it so we can retire. We want to make sure that we're being tax efficient and not giving all those gains to the government. We want to make sure that if anything happens to us, the people that we want to have the money get it, that wealth transfer. We want to make sure that healthcare is covered, no matter if it's from Medicare or whatever else we do. We want to make sure that all those 5 things are done. So as we're going through a process for someone, de-risking is one thing, but the main thing is where does that fit on your overall plan? That's super important.
And at J. Hagan Capital, we're here to help you figure these things out. Let's start the conversation. You can give us a call right now. 502-317-0840 is the number you're dialing. 502-317-0840. We've got a teammate standing by to answer your call off the air and help you schedule a time for your initial 15-minute phone conversation with one of our advisors. This is a no-fee, no-obligation initial conversation, just a space for you to ask some of your questions, express what you're concerned about. Then we'll explain to you how we might be able to help and begin the planning process, a plan that's customized to you and your goals. 502-317-0840. If you're over 59 and have saved $500,000 or more, this is where you're really going to see the benefits of the kind of planning they do at J. Hagan Capital really take effect. So let's start the conversation for you. 502-317-0840. You can also go to retirementsolutionradio.com or call us right now. Let's plan a time for your no-fee initial conversation. 502-317-0840. The planning process over the years, I don't have to explain to you, John, how more and more complicated it gets year in, year out. Think about where retirement planning was when you first started versus where it is now and how much more complicated it's gotten.
25 years, it is amazing how much more complicated it's gotten. And it's not because it's evolved so much. It's like there's so much more information overload, right? There are more mutual funds to invest in than there are stocks on the New York Stock Exchange. Guys, think about that. That's just kind of crazy. And that is just one part of an investment side. Now you have all the different cryptocurrencies. You got all the different real estate opportunities. You got what that, and that's just investments. Then you go into how do you develop income? What are income stream structures? Then you have taxes. Well, what about taxes when you're working? What about taxes when you're retired? What if you have joint citizenship? What if you have different states of occupancy? What if you have You got all the taxes, and then you have estate planning, and on top of all that,
what about
you
the free set of steak knives?
That's the whole thing. It feels like it's a late night infomercial, but it's all bad news or complicated news. Right? It's not like set it and forget it. It's the rotisserie oven from the future. It's so different than that. And it's not getting any easier. The new administration and it doesn't matter what side anyone's on, for good or for bad. They're making changes every singular day that impact our pockets differently every single day. And so because of that, it makes us all go, what did they just do? Hold on. When does that take effect? Is this retroactive?
Is that today?
What do we do now?
Is that next year?
And I'm not going to lie to you guys, not just because it is my occupation, it is a full-time occupation. To find out what the administration's doing, will it hurt or harm you, and what are the next steps that, again, are not just going to be steps to take just because of the current administration, because there will be an administration
after this. That's what I was going to say. That's not this administration. That's all administrations.
Right. It will always change. And if you think about 25 to 35 years of retirement, guys, it is a ton of changes. And it's not going to get easier. It's probably, my assumption is, it's going to get more complicated. Yeah. So it's really important. Even if you've never had a financial advisor in the past, and guys, I'm on your side. I agree. I think so many smart people that are great savers and they make a good amount of money. Yeah. To save the money, you do not need a financial advisor. I'm not even going to lie to you. Now, I'm not saying this for everyone, but a vast majority of people that do real well, they understand their own thing. They don't need a financial advisor to grow their money. You know when almost everyone needs a financial advisor, including Warren Buffett, including Mr. Wonderful, including Mark Cuban, the billionaires. Do you know when they actually need an advisor? When they're actually thinking about exiting their companies or exiting the workspace, which means retirement. Yep. That is where all of these things require serious CPAs, serious tax attorneys, serious estate planning attorneys, and most all those guys operate in different silos. So to feel like the information you're getting is close to a billionaire, that is what everyone should seek. Okay. The question is, do you really need it? Okay. And I get that. And that's a question for everyone. But as we get closer to retirement, that is where those things are so much more important, that they're integrated together into a system that works.
Jon and his team at J. Hagan Capital. This is a local, independent, family-owned fiduciary advisory firm. Offices right here in Louisville. So as you're listening to Jon today, if you want to ask him some questions, let's put a time on the calendar for your initial 15-minute phone call. It's a no-fee, no-obligation initial step in the planning process. 502-317-0840 if you agree with what Jon's saying and it feels like it's getting more and more complicated and you need some help simplifying, or you're realizing you're just close to retirement. You've been a great DIY investor. We're here to help you start the conversation. Give us a call, 502-317-0840, or visit us at retirementsolutionradio.com. Let's get to one of the points that you may mention just now. You make mention on almost every radio program we do because it's so important, the idea of how to better tax plan for our retirement. And something you listening to us on the radio, you might have heard stories about the super wealthy, the billionaires, the pro athletes, the things that they can do because they have some freedoms to do things that maybe the rest of us don't have. They just up and move to a state with low or zero income taxes. But can that strategy work for the rest of us who are approaching retirement? This is wealth manager Jeffrey Levine on the Decoding Retirement podcast.
Where I have seen in my experience people base their decision solely or too heavily on where they're going to have the lowest income tax bill. At the end of the day, when you get to retirement, you've done all the hard work to get there, right? You've worked for the last 20, 30, 40 years, in many cases even longer than that. The last thing you want is to go somewhere purely because it's going to save you a little bit in the way of taxes, but you're just not happy there.
Especially, what if it takes you away from your family or your friends or your lifestyle? One of my girlfriends was telling me, where is Djokovic from? Serbia?
Yeah.
Is that right? Okay, so this woman moved her mother over here to the States from Serbia less than a year ago, is already moving her back because her mother fell apart here. So let's talk about somebody approaching retirement, has maybe toyed with the idea of relocating for taxes, for tax purposes, for tax savings. What are your thoughts here?
So, I mean, perfect case example. You were just talking about your friend whose mother came over from Serbia and she's already going back.
That wasn't even that was to be near family, but wasn't a good idea.
Right. So I was recently talking to a billionaire in the state of Texas, and he recently just had an exit from one of his businesses, and he's going to be sitting on billions of dollars. And we talked about and actually paid for counsel to discuss, should he go to Puerto Rico? Why? Because if you actually relocate to Puerto Rico, your federal tax bill is only 4% a year. That's not a joke. That's real. The question is that his whole point was, well, does he have to be there every day? And the truth of the matter is he has to be there for 183 days out of a year.
Is that exactly
able
half?
To pay that? It's exactly half of the year, right? And so when you think about that, and we went through it, okay, so he does have access to a private plane. Would it make sense for him to get back and forth? It would. But here's the thing, guys. He's not Spanish speaking. He doesn't know anyone in Puerto Rico. His wife and his wife's sisters and all of their grandkids and all that stuff, they're in the United States. They're in Texas. Yeah. And so even though it's not that long of a plane trip, it made absolutely no sense, even though the tax benefit was awesome. So there's a couple things I want to do right now. I want to talk about the situation where tax moves work.
Okay.
And I want to talk about some of the horror stories that I have physically seen and how we can avoid those.
Yep.
So the two big ones. Number one, let's assume, and I had clients that came down, I believe it was part of the YUM merger when Yum executives came down from New Jersey and they came down to Kentucky. Mm-hmm. So I had a couple, they both did exceedingly well. She was an executive with Yum and he was an attorney. Okay. And so they both had about $250,000, $260,000 of annual income. So they were high wage earners, and coming from New Jersey, which is like a 13% tax state, down to Kentucky, it felt unbelievable. So they had already made a tax move really because of their jobs. They ended up being great. Well, here's what we discussed. What we discussed was, does it make sense for them to retire because they didn't have a ton of family in Kentucky? Their jobs were here. They raised their kids here, but then their kids were off and out. They asked, should we go down to Florida? So we did the math on that. And what we discovered was it did actually, in fact, make sense for them because they loved their home and they would like to have a similar home in Florida, but it would have been more modest. It wasn't a huge home because property taxes, insurance costs, and things like that were much more expensive in Florida. It actually made sense for them to relocate to Florida because they had been already used to paying New Jersey taxes. To go to Kentucky, which was less than half, was great. And to go from that to Florida made total sense. Okay. So for them, that was a good opportunity. Another situation where it was very, very attractive for someone to consider a tax move for retirement is a business owner that wanted to take a buyout. He was going to get about $12 million from his company sale. And what he realized was he was going to structure that buyout to happen 9 months later because he was going to go ahead and truly move to Texas. Why? He loved Texas. He had family in Texas. He wanted to live in Texas. And not only that, but Texas is a 0% tax state. So his business sale, because it happened more than 6 months prior to his exit, he was able to be taxed as a Texas citizen or a Texas resident. So he paid zero income taxes at the state level on that business transaction. Those are two very awesome situations where it can make a ton of sense. But now let's get into the but. So here is where, unfortunately, tax moves backfire. Every time that someone says, hey, all these billionaires, they do this. When you hear that Robert Kraft, who is the owner of the Patriots, is moving down to Florida, it makes headlines, right? And so we all think we need to do that. But let me tell you some of the issues about Florida. I know because I have properties down in a lot of different states. The insurance shock of the state of Florida, when you look at what it costs to insure a home in Florida, it is not just twice as much, ladies and gentlemen. It is often 2.5 to 3 times as much money to insure a home in Florida. That's no joke. Okay. Number 2. Healthcare access. If you get aggravated in the region that you can't see your doctor when you want to, it's 4 to 5 to 6 months of a wait to see who you want to, your specialist or whatever. Yeah. When you go down to Florida, where their system is even triple taxed, not from a tax standpoint, but the number of people going there, the access you're getting to healthcare when we're aging, which is when we often need it more than ever before, it is unbelievable. Not only is it difficult to find providers that you would feel comfortable with to do the services, it costs out of pocket more money. That's the average American moving from Midwest area, so Kansas, Kentucky, Indiana, say that middle area, going down to Florida, will potentially pay between $2,000 to $3,000 a year more for out of pocket expenses just because the way the system's set up. People don't expect that. Another one is property taxes. Okay. So people will say all the time, oh, well, John, I won't pay any state taxes. Yeah. Kentucky really isn't that bad when it comes to state tax. And I know that Florida and Texas and Tennessee are 0. Yep. But your property tax is a major surprise. Most people don't realize that the property taxes in Texas are almost 70% higher than Kentucky.
That state's got to make their money some way or another. So
they have to. They absolutely do. Yeah. And then let's talk about Tennessee, where a lot of my family was originally from. If you look at Tennessee for sales tax, when you add all the extra stuff in, it's about 9.65%. When you look at actual sales tax in Tennessee, I believe, I'm looking at it right now, 9.56% when you look at state plus local sales taxes. So guys, if you're a consumer, if you want to do fun things in retirement and you're giving up on a state that you're only paying 4.5% to go to a state that is 0, but you're paying 10% in consumption style taxes, guys, it adds up.
Watch out.
So the whole thing, so at the end of the day, here's what I want everyone to consider, whether you should or shouldn't relocate like billionaires do. Yeah. The question is, do you know your own math? Do you know what you're actually paying here? Would it actually be closer to friends and family and grandchildren? Or is it just sound like a convenient way to think you're going to save money, only in the long run to be miserable or worstly, pay more money and be in a place where you don't know as many people. Yeah. I love the pros and cons to anyone achieving what they want to get in retirement. You should never let the tax angle be the real reason you do something. You want to find something you really enjoy and then find out, would you enjoy it just as much or more in a lower tax environment? Or would you potentially pay more money because of the things that you like to do and the way you live your life? That's the real question. That's what a solid, skilled fiduciary who has CPAs and tax attorneys should do for you any day. And that's what we do at J. Hagan Capital.
You've got these types of people on your team, on your staff, John, because actually I always love the conversation you talk about the hiring of the CPAs and the tax attorneys. You're like, I needed them for myself, for my own, for your business and your lifestyle and your family. So you just hired them and now you've got them at J. Hagan Capital to work for your clients as well. So when it comes to understanding, John's got that, to say the very least, when it comes to helping you figure out your tax opportunities in retirement, whether that's relocating to a different state, staying here in Louisville. Again, crunching the numbers, doing the math, showing you what the pros and cons are of your options is what John and his team can show you. Let's start that conversation. You can give us a call at 502-317-0840. What are your tax opportunities to better position yourself in retirement? 502-317-0840 is the number you're dialing right now. A teammate standing by off the air, ready to answer your call and help you put a time on the calendar for your initial 15-minute phone conversation with one of our advisors. This is a no-fee, no-obligation conversation, just a space for you to ask some of the questions you might have about taxes and retirement. We'll explain to you how we might be able to help and then begin the planning process with and for you. 502-317-0840. We're going to be here for a few extra minutes after the end of the program today to ensure we answer your call. You can also find us at retirementsolutionradio.com or it's 502-317-0840.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.